Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, April 28th, 2022, aka what I'm calling D-Day. Today is the big day. It's the conclusion of the big market leading FANG stocks, and actually I'm going forward, FANG, it's hard to pronounce. I don't say FANG, F-A-N-G. Years back, I dubbed them the FANG, F-A-A. MG stocks because the N in FANG Netflix was way down the list and no longer a market mover. And now, really going forward, if anything, has got to be the TANG or something. The acronym gets tough to pronounce, but TAAMG, because those are the five largest: Tesla, Apple, Amazon, Microsoft, and Alphabet, which is GOGL, the two share classes. Because Facebook, we'll talk on that in a second. We'll get to Facebook, but here's I'm starting out here. I'll loop back to the FANGs in a second, but I'm calling it D-Day because although we're not really going to know until after the market closes, that's when Alphabet and Amazon, the largest company in the world, and Amazon is now right behind Alphabet and Microsoft. So two of the largest companies in the world, and more importantly, the biggest weighted components of both the Nasdaq 100 and S&P 500. So here's what we're looking at. I'm just starting out big picture that has the potential to, well, let's just say technically change by the end of the close of business tomorrow. Remember, the fireworks, those big fangs don't report till after the close. So as far as it being D-Day, nothing major is going to happen today. The market will go most likely into somewhat of a holding pattern back and forth before Apple and Amazon report. But really, it has the potential. Doesn't guarantee we're going to have explode to the upside or go to the downside, but this certainly has the potential to set the tone for the coming weeks to even months. So the first thing, just starting out here on this monthly chart, is as of now, and again, a lot can and will change by Friday 4 p.m. That's when this candle is finalized. This is a monthly chart, so this is the last trading day of this month will be tomorrow, and that's when this candle is finalized. And I've talked many times, it's not 100% accurate. There's not a single indicator out there that is 100% accurate. If there was, we'd all be using it and everybody would be rich, but it just can't be that way. So, but again, this is about as good as any for the long-term trend, and that's when the Nasdaq 100 and the S&P 500 are above their 20-month exponential moving average. Okay, so talked on it many times in the past, and won't go over it here. There was a slightest marginal close below it that back then in the fourth quarter of 2018. And you'll call it a whipsaw, is what it was, but not much. By the next month, you were back above there. And it was also associated with a 24% drop low to high. Even when COVID hit, COVID was a correction in the Nasdaq one and the stock market, in my opinion. Even though the S&P fell 36%, Nasdaq fell 31 from high to low. But and the media would call that a bear market, but I don't. It's just brought us back to our primary long-term bull market uptrend line in QQQ. You see, we closed the month above that, and we closed it above the 20-month moving average. So as powerful as that drop was, it happened so fast that intra-month we went below, but then closed and never took out the 20-month on a monthly basis. And you can see it's defined this entire bull market, or the majority of it, since the 2009 lows when the S&P 500 and all the other indexes bottom, crossed above it, and it's just acted as phenomenal support. Again, look at the fat parts, the bodies. If they're above, then you're above trend, you're in a bull trend. 401k type long-term investing stuff, and then every bear market that we've had, and there haven't been many in decades now. We've had two real bear markets, 2000 to 2000, late '02. That's when you took it out with conviction, stayed below it, said you were in a bear market, recovered the 20-month there. You were in a bull market up until 2007, October, took it out. Bear market, took it back then, and have remained above it. So that's it. And again, is it take everything I have and throw it all short, or get all my money out of my 401k? No, there's other things. And again, there's has been a few whipsaws, not many, but there's certainly been a few, enough to say that it's not definitive. The other thing is the PPO, and these are things, these sell signals we got a while ago, and these were I was tracking at the time. Bearish PPO crossovers that happened back here. That trend indicator flipped to bearish and solidly remains bearish. In other words, and again, that's what each of these big drops, all of them, double-digit drops, including all the big bear markets as big as 84%. Every single one of them was associated with a bearish crossover on the PPO, and the histogram goes red. Um, so that's it, guys. So I have a mountain of evidence, reasons to be short and believe that we're in an early stage bear market. And this will only be an additional check mark, and then open the door to my target, longer term swing target of a pullback to the bull market trend line. And again, I know I'm in the minority. That minority is getting a little bit larger and larger, I'm sure, as the more we go down. But at that point, like I said, it's only going to be a correction back, a mean reversion. It'll be a healthy one. You can call it a bear market. The press certainly will. It'll be a drop from whatever. I already measured on the weekly chart. My target's about 42% from the November highs. All right, so let's get off that. That's it. Let's just see where that closes the month. And again, like I said, it's just a check mark. It's not a definitive, immutable force. And by the way, we're not going to have it on the S&P 500 yet, unless we get a big down and it's possible. I'm going to measure it out for you real quick. So we're right here. The red candle means the fat. Where at the bottom of that, the body is we're at the bottom of the body, the fat part. And the 20-month is 1.61% below. So if something crazy happens with Apple and Amazon tonight, there's the potential. Let's just say the market were to drop from where we're at right now, and easily doable, very easy. If those guys really get, both of them especially, get clocked, we could print a solid close below there, and that is your get out of Dodge moment. And you'll know it. The thing is, you don't have to wait till 4 o'clock on Friday, because if it 2:30 p.m., 3:30 p.m., 3:50 p.m., you're down there, and it looks, you're so far below it, there's little chance of recovery. You may want to, at that point, go ahead, because usually most 401ks and mutual fund type plans have up to 4 p.m. If you get your changes in before then. Some have a 3:50 cutoff, so keep that in mind. And again, not telling you what to do, just food for thought. And not only that, that's just one of many things. I talk on all of them, the big levels here, support levels, especially QQQ. So here's why it's D-Day, not just because there's just another support level. First of all, it's a huge support level now. Three distinct tests in the NASDAQ 100. This is, I consider, the market leading index. It's not the stock. It's not as diversified as the S&P 500, but it's chock full of growth companies. And if the economy is not growing, that's when the economy is growing and strong, this index leads. Every bull market, it outperforms the S&P 500. When we go down, the only exception was the financial crisis. They went in lockstep together because the banks imploded and went to near zero at that time. So both the S&P 500 and the NASDAQ 100 had about, and I'm going from rough memory, it's about a 56% drop, 55 on both, only because there are no financials in the NASDAQ 100. And there's a significant, and even back then, an even bigger percentage, and now, today, I believe, in the S&P 500. So therefore, that was the one instance where you had both index, but normally, and I believe in the next bear market, you're going to see the NASDAQ 100 outperformed on the downside. And that's why I often talk about why it's usually my preferred proxy. If I'm bullish, I'm bullish the stock market, and again, with exceptions at times, but normally I'll go with the NASDAQ 100. And if I'm bearish, I'll go with it, because I'm either going to be right or wrong on my call. So, if you're going to be right on something, why get paid one time on your money when you can get paid 1.5? You're either going to be right or wrong. So that's kind of my mindset there. And then, of course, we have not only the big caps, we have the small caps. Russell 2000, look at this, taking out the recent lows, just like the NASDAQ 100. It had a double bottom back here. This is also more of a risk-on index, tends to also outperform the S&P 500 both to the upside. When a roaring bull market, you'll usually do better because the smaller company is typically, the faster the growth rate. Larger company gets, it reaches that mature stage, and their growth rate starts to slow. So again, overall, and there are exceptions in different points in times where the small caps can underperform, but usually it cuts both ways. In a strong bull market, small caps will outperform the S&P 500, and in a bear market, they'll fall more. They'll outperform to the downside. All right, so now what do we have? We have the roughly still triple bottom, but we're breaking it. We're breaking that support today. As I mentioned yesterday, the only thing that keeps me up at night, and I'm a, as far as the market goes, I usually shut down and that's it. And but this is, and again, metaphorically speaking, well, the thing that concerns me the most is what I'm trying to say is these big divergences, and it is. I mean, you guys know me. If you follow me for a while, this is a big component of my trading. Um, I like to go long bullish divergences. They often indicate trend changes. It is still what I call unconfirmed. I went over that yesterday, meaning they're momentum indicators and they can continue lower. That's still my bet. That's where I think they're going. However, it's a kind of bet you don't want to go all in on and be wrong for too long because again, I can go back at all points in time, show you big positive divergences on the daily, and if they were to play out, they would play out most likely for a move to new highs. I'm betting against it. I'm remaining short my trend and longer term swing trading accounts, those positions. I'm certainly going to keep the trading account a little bit light going into the close today, but I'm going to take that gamble, and then I'll just manage my stops appropriately. I trade futures with the indexes primarily, so if futures rip up, I'll always sit back. I don't overreact to the initial reaction. That's often faded and reversed. But if the futures continue to roar, climb overnight, that's the thing about stock futures or any position. But on IWM or QQQ, you have till 9:30 to 4 p.m. You can do your stop limit orders after hours, but that's tricky because here's what happens, guys. I'm just going to digress, and hopefully this is just a little trading tip. From now, every time to time, I like to talk about different order types, and especially in periods of a volatile market when we're having these 3% up and down days with turnaround from high to low. We've seen quite a few days in the last few months with 5, even 6% ranges from high to low, and that's pretty big. So what happens is, let's say you want to whether it's long or short, doesn't matter. Let's just pick you're going to go home heavily short, right? And okay, so you're not going to know what Apple and Amazon do till after the close, and then the futures. Let's just say the futures start going up. Let's look at let's pull up a futures chart. Here's the let me go to a 60-minute chart and just show you what's going on there. This is the NASDAQ 100 futures. So we have, like I pointed out, a lot of stocks and indexes all the way from the daily time frame down to the 60-minute time frame, positive, aka bullish divergence. In fact, here I'll zoom out a little bit farther for you. I'll go out to 3 months and just show you what the NASDAQ 100 looks like. So here it is. This is our divergence right here. It's actually been building in the RSI for a while from this point down. In the PPO, we have divergence here, right there at that last point. So I'm going to zoom it back in. Let me just go here. I can do it this way. Take it back in a little tighter and show you this is a divergent low. And this is normally on a 60-minute time frame when I'm covering shorts and going long. So it's at least enough for me now, because it will be a gamble going into the close today. Apple and Amazon can go either way. Based on where we're at in the bigger picture, even if they pop initially, I favor a fade next week, but I'm not married to that. Meaning, if they pop, that we go back down and then take out the recent lows. But it would be uber bearish if these divergences right here fail to play out. I mean, when I say fail to play out, so far we've rallied from that divergent low the other day. What is that, 4%? Okay, so 4% is a blip. That's markets going up and down, sometimes 4% or more in a day lately. So that's not that divergence playing out for years now, since at least the bottom in the COVID lows back in March of or yeah March of 2020. Every divergent low has been the catalyst for the move to new highs and beyond. So by not playing out, let's just say we failed to even get above. This is a pretty big level. I had it color coded yellow because remember recently we had this trading range here, and I said a break of that would be, a check mark or a battle. This was a battle between bulls and bears right here, a consolidation range, and the bears won it. They took it to the downside right here. Let me grab that circle. Bulls couldn't get up back up in there, and then once it was clear to all that the bears won, with the words I'm speaking metaphorically, buyers versus sellers. There were more sellers in the market, and buyers that buyers that wanted to get out had stops hit or shorts that jumped in, and so far they've won. So there it is. And again, you go back bigger picture. Let's pull it back a little bit more. Forget about everything I'm saying, this, that, and the other. Let me just go back to right here at this point. Remember, the NASDAQ 100 topped back in November last year, but here's March 29th, end of March. So this is our current trend right now, right? That's a downtrend. A downtrend is simply defined as a security making a series of lower highs and lower lows. And that's what we're in. So, however, divergence is often warned of a downtrend now, but here's the thing, and I've been talking about this, is that a character of a bear market or larger bearish trend is that bullish developments, bullish chart patterns, aka bullish falling wedge, positive divergences, things right there, that's what we had, fail to play out for anything more than just a blip. They get sold into. And so, yeah, that bullish falling wedge played out. I believe I would have highlighted at the time, and it was, tradable. Absolutely, for an active trader, that's probably 4 or 5% there, quick move. But it was a minor blip, and the downtrend continued. In other words, that breakout was met with a lot of sellers that took profits early, and then you went down and made the next lows, and then of course, you set up with these multiple reactions there, and then it becomes apparent that there's no more buyers left, and then the next leg down starts, usually with a break of support, like right there, that little triangle pattern. So that's it, and let's not over complicate it here. Let's just say that we're sitting on, again, I believe without a doubt, the most important technical level that we've seen in many months, if not years right now. And especially the fact that the onus is on the bulls right now, or the bears, if however you want to look at it, to take the ball and run. Bulls, in other words, need to step in here. Again, metaphorically speaking, just talking about buyers, hedge funds, pension plans, individual investors. If they like what they hear with Apple and Amazon, they've got positive divergence. That could be the catalyst for new highs in the market, at least to run up. Again, I've talked about there's a mountain of overhead resistance, but if they fail to do that and we break down and we go significantly lower and we take out these divergences, that is a huge change of character to see a nice positive divergence, triple bottom support, right? Well, more than just these three. And again, we've had support back here. It was a major support level back in May and June of last year. So that's that. Oh, and let's not forget today's headlines. GDP came out, and for those of you not familiar, gross domestic product is a measure of all the goods and services in the U.S. So it's like the measure if the U.S. was a corporation, that was their earnings report, right? So to speak, simplistic view, and that comes out every quarter. And so first quarter GDP was a huge miss. They were expecting. Here, let me show you one sec. Okay, if you go on right side of the chart, if you go up to the top of the page and click on support or resources, you come into the support center and you go down here and you click on economic calendar right there, and then it'll load the economic calendar from Day. And this is today. It'll show you the market moving events. Here, I'll scroll it up and I'll zoom in a little bit. Market moving events are indicated or denoted with a red dot. So there's GDP and jobless claims today, and you click on the report which I just did. Click on that. It's going to load, and it shows you that the consensus, those brilliant analysts out there, thought the U.S. economy would grow by 1.1%. Previously, you had a surge, 6.9. Remember, the Fed and the federal government have intense, grossly overstimulated. The reaction to COVID was a gross overreaction. Obviously, we know that in hindsight. We have runaway rampant inflation, and consumers spending. This is 1929. If you read history, this is what it's like the Roaring Twenties. I can tell you that, at least down where I live. I mean, the amount of what's going on in the housing market, the cars that are driving by, and the huge boats out in the river in the Gulf of Mexico that are new boats with insane amount of money. Everyone's doing well down here. I don't Other parts of the country I know got hit hard, but we never missed a beat, and I know that was the case in a lot of areas in the country. So let's not debate that. That's just reflected in the GDP. Previous quarter was a quarter over quarter. Prior was 6.9%. Consensus 1.2. Even the range, meaning the most bearish analysts figured that we'd grow by just a modest 0.2%, and range was up to 1.9. We came in at negative 1.4. And the way these things usually work is GDP is subject to revisions. You'll usually get after the fact revisions, and when it starts a miss like that starts going down, those revisions are down. Okay, where am I going? Well, a recession is defined as 2 consecutive quarters of contracting growth. So now we're halfway there. I don't know the statistics. It's not my job. I'm not one of those folks that go on CNBC and come out and cite a bunch of statistics. You can look it up, but I don't know where we've seen the Fed just begin. Remember, they just started raising rates last month, and they're going to they pretty much guaranteed you they're going to raise again, and continue to raise. So I would be curious to know at what point in history has the Fed started raising rates when you had what could be the beginning of a recession. Usually they raise rates after the economy is overheated, which it has been. But look, it's already down. And what they did, and look, I just scanned the headlines. They said, oh, yeah, that was because of supply chain disruptions. And I get it. In other words, there's huge demand for cars right now, right? But Ford, who reported last night, and you can go look at GM, all of them, they should be making money hand over fist. Let me grab this here. So, because there is huge demand for cars right now. I know because we have 2 teenagers, and right now, my youngest turned 16 not too long ago. They're sharing a car. Can't find a car to save our lives at a decent price. So, I went to the lot. The lots are empty right now. So we know that there's huge demand for cars, but guess what? They don't have the chips. They're not making them. And now, so what they're doing, this is a missed opportunity. And so Ford is down 46%, chopped almost in half since the beginning of the year, right? Yet this has been the strongest demand for cars. Here's my point, if they're not making money in this environment, what's going to happen if the economy continues to slow and then all that demand starts to dry up? They might have all the chips in the world coming in, all those backlogs cleared, and then they're going to have a lot of cars sitting on their lots, and they're going to have to start discounting. So scary to think that if they are not profitable in this market, and they haven't been, because look, if you run a business, usually your biggest problem is lack of demand. But the only thing worse than that is having the demand but not having the product or service to sell to meet that demand, because you're not profitable just based on demand. You're profitable in sales. So anywho, that's just, these are tells. These are it's General Motors. General Motors also peaked down 45%. Now, again, this gives me pause. A lot of these have divergences. But here's what can happen here. 46%, remember, here's the thing, here's the way mathematics works. If a stock drops 50%, you don't have to make 50 to get back to where you were. You now have to make 100%. So to Ford or GM and Ford to get back to where they were, they need to nearly double. not go up 50%. So where am I going? Depending on what happens soon, whether Apple and Amazon are or are not the catalyst, they can bounce. This is a bullish falling wedge, but it would be a bear market rally for them, at least. And there's big, that's why I had that line color coded yellow. That was a big support level. And this is just a common pattern I'm seeing in so many indexes, sectors, key stocks, these topping pattern. That's the stimulus ran us up to nosebleed levels, and rightfully so. I mean, the demand was there, profitability and all that, uber low interest rates. Half the gains or more, I think, in Apple, Amazon. There's a lot of big, especially big tech stocks. Is financial engineering, stock buybacks. Zero interest rate policy for so long. I've talked on this before, and this goes back for years now with these uber low rates. Apple is a great example. Apple is the most profitable company in the world. Tons of cash on hand. But several years back, after the whole free money party started in 2008, Apple started selling bonds. Why? Why do most companies sell bonds? Most companies sell bonds to borrow. It's a way of borrowing money. A bond's an IOU. You buy a company's bond, they turn around and use it to invest in operations, open new plants, new product development, research. But Apple didn't need that. Historically, cash-rich, fast-growing tech companies didn't issue bonds because they didn't need the money. They had their biggest problem was where to put all the cash. So what Apple started doing said, look, we're going to go ahead and we're going to issue bonds. We're going to use the proceeds because we can borrow it next to nothing. We're going to use that money to buy back our stock. So that's financial engineering. And again, it's brought up where it is, and we'll see where they go today. Let's just wait and see what happens. I will say 60-minute chart. We don't have the divergence like Facebook did. We had some divergence here. No divergence, right? No, I take that back. Wrong. There's some divergence. I just hadn't updated this. I really hadn't looked at the 60 on Apple. There's some divergence there. Daily chart. I've covered this quite a bit lately. No divergence on the daily because you're making, you have a higher high on the indicator on the PPO and the RSI right now, but you don't have a lower low in price. And Apple is sitting on, I beefed up this trend line that I was showing you. This is the trend line I'm watching, and then turn off all the lines, dancing right on its key 200-day moving averages, which do a great job of defining the bull or bear trend, the larger bull or bear trend in Apple. So there's Apple, and then the other one is Amazon. Amazon also, it had a divergent low here, and it had a nice rally, but it faded all of that, which number one, this in itself right here, this is not bull market action. Bull market action, when you have a bullish falling wedge, positive divergence, again, is typically the catalyst for the move to next highs and beyond. Now, we can come on down. These guys can miss, sell off a little, then put in divergence. So this is something we have to watch. And this is where I can tell you that I will pivot. I am not married to my long-term targets. I've been reiterating those targets on QQQ on the weekly chart. I think we're going to get there. I'm highly confident we're going to get there. It's just more of a matter of when and how. If we're at where we think we are, you know me. I'm going to tell you what I think might happen. I won't be wishy-washy about that. I think that whatever Apple and Amazon do, the market's not going to like it, and that's my theory. If there's ever a time to have these divergences and all this burn through and those big support levels I just spent the beginning of the video covering, it would be, if those are to break down, it would be on a disappointing earnings from Apple and Amazon. Again, it's not about the numbers, even the guidance, it's what the market's reaction is. But technically, from a technical perspective, we seem to be where we were in other bear markets, the whole UR thing here, where you break the 200s, you test them, you get rejected, you come back a couple months later, you test them again, another rejection, and it meshes with an Elliott wave, P3 primary third wave down, which is usually always the most impulsive if you have a 5-wave primary wave count. A, B, or 1, 2 up, 3 down, 4 up, and then 5 down. That would take us down there. Again, if you have a perfect Elliott wave count. And again, that's not my forte, but I do recognize that it often plays out. It played out that way in the last bear market back in 07, 09. All right, so let's just let's kind of look at the 60-minute charts real quick, and I'll wrap this up. I already showed NQ for you. Here's QQQ. Still, even though it's marginally above those two previous lows, effectively it's still holding that, and it's above it right now. So that is a successful defense, even a dip below. Positive divergence. So again, the onus is on the bulls to take the ball and run. They've been given, the ball. They have they're holding the line right now. They're in control. But if that level goes, and it goes with conviction, what does that mean? Let's say Apple and Amazon, there's an initial sell-off, but then we recover, and these divergences are still intact, and the daily divergences are intact. QQQ, positive divergence since this point here. We just made a marginal new low, so now we do have divergences. We need the PPO to curl up to what I call confirm it, but it is divergence, and that's my thing. That whole confirmed, unconfirmed divergence, something I made up just because divergence just by definition is indicators making higher lows. But again, when the PPO curls up, it means that momentum has turned because it's a momentum, and you put in effectively a higher low there than those previous lows, or especially this one here. So that's it. So that's what I want to see to get a check mark. See those divergences burn through. Otherwise, got to respect it. We could be looking at a pretty healthy rally, even if it's a bear market rally, one that you may not want to stay short on. So if any takeaway from this video, it's going to go either way after tonight. Tomorrow's Friday. This always seems to happen. So sometimes you don't have immediate resolution or clarification on which way the market's going to break, and they're going to keep you guessing. So come 4 o'clock Friday, whatever you have, you're going to take home for the weekend, even if it's stock futures, because they'll shut down Friday, as well, Friday evening, and not pick up till Sunday evening. And so you're going to have to make that decision, and know that you have the extra 2 days of overnight risk, so anything can happen. All right, before I wrap up here, I don't want to be super long. I'll do updates. Nothing's changed. Gold's still above that weekly breakout. I'll do gold and silver in another video. The only other thing I wanted to get to, because it's somewhat related. It's a completely different asset class, but related to the stock market in a way, because stocks and bonds tend to move inversely. So I'm just going to talk on this real quick. This is TYX. This is the 30-year bond. Remember, I've covered this chart many times over the years. We have been in what we call a secular bear market in interest rates. Interest rates peaked back in the early 80s, beginning 1980, right there. And this is the 30-year bond yield, and rates have been falling. All these along the way, that's a cyclical bear market and then a cyclical bull market. And this whole big thing is a cyclical bear market, and it's so well defined, that downtrend line. In fact, we were moving down in a nice price channel like that, but what happened is there was an extreme, I shouldn't just say artificial. We've had artificially manipulated rates for quite a while, ever since really Federal Reserve kind of came into existence, but not more so in recent decades. But then boom, these are the rounds of quantitative easing. This is when they came in and really artificially changed natural market forces, and that's why you had these plummets out of the channel. That's when the Fed came in, tried to stop the financial crisis in 08, and every time the market threw a little hissy fit, they stepped in and did some more, and then the all-out nuclear reaction. But we're back. See, I'm a firm believer in these things. It's just almost a natural flow. You can only, temporarily alter the course of where things are going to go. And what happens when you mess with it too much, there's usually a hard mean reversion, and that's what we had. These are interest rates have shot up, rallied up, but as I've been pointing out for the last few weeks now, we are coming up to a major downtrend line, and we hit it. We're there. We kissed it almost to the button. I've told you recently, I've been scaling in, layering into Treasury bonds. I remain long-term bearish on bonds, but if interest rates pull back, bonds go up, and that's what's happened so far. I do believe this will break out. I do believe we will, if we probably have already started a secular bull market in rates, So this whole thing is over. And by the way, that also speaks to the stock market. You can overlay here. I'll do it for you. We do that. That's what we're supposed to do here. Comparisons. S&P 500. This is no coincidence. You've had just the most bullish stock market pretty much in history. You've had huge gains in the S&P 500 for decades now, with bear markets along the way, because falling interest rates are bullish for equities. It's bullish for multiple reasons: lower rates, lower borrowing costs, so there's more investment. People buy. You can buy more house for the money, more cars. Everybody does well. And then it's also the alternatives. Back here, let me turn off the S&P 500. All right. Back here, these were Treasury rates. They were 15%. That's what the 151 right there means, 148. Just move the decimal over, so 150. These were Treasury bonds. When I got into business, I was a broker back in Merrill Lynch in the early 90s, and I had clients coming in and giving me, I remember those 13, 14, 15-year Treasury bonds. They had the old certificates. That's old school stuff. Now everything's done electronically. That was a real thing. And so what we've had since then is falling rates. We're going to go, I don't know if and when we're going to get back to 15. I don't even care. I'm not making that call right now. I'm just telling you that it appears that we are most likely bottomed, especially from this overshoot. So I think we'll pull back here. And where I'm going, guys, there's a point to all this with the bonds. Okay, so I predicted this recently, and now we're seeing it so far, maybe with the big miss on the GDP, the negative, the contracting quarter. And what that's going to do is going to help the Fed. And the Fed is probably, Powell's probably ecstatic to hear that, because now he doesn't want to be the man charged. He knows they've screwed up. He knows damn well. Every one of those Fed board members that have been dovish, there were a few that were dissenting, in recent years with keeping the rates so low for so long. But now he's going to be the man blamed for a big recession if he has to keep doing these 50 basis point hikes coming up. So where I'm going is this gives him a little breathing room. If the economy starts to cool itself down, which obviously that just showed the GDP numbers, he doesn't have to be as aggressive, assuming inflation abates. Now, there's some other forces there. I could get in talking about the housing market and all this, other shortages, but that's for another time, another discussion. This is just technicals. There it is. So I still think that longer term we'll probably break above this channel, but probably not right away. We're so overbought just to get there. Oh, you can see down here. Here, let me park my PPO and show you something here as well. Kind of long-term stuff. Why isn't that park and move it? All right, I'm going to just shrink it. You can see down here on the RSI, this is really about 57.72 is a number that does the trick. This yellow line, every time we've hit that yellow line, we get that's really overbought. That's where you get at least a near-term pullback. But what I did, the circles are where you popped above that level. And here, I'll show you real quick. Remember, in a bull, all of these were bear market rallies. That's why you never hit the full 70 level. Last time you were at the 70 level on the monthly RSI right here was when we were in a secular bull market. That was the tail end. This chart only goes back to the mid 70s, but that's when rates were rising. They peaked right there. So it was common in a bull market, just like the stock market. I talk about this all the time. In a bull market, oversold often becomes more oversold, meaning you go above that 70 level, and stays oversold for an extended period of time. You had persistent oversold readings leading up to the top. But once the bull market ended, you had bear market rallies. You never even saw the 70 level. You're getting close now, but it was those spikes to about, just above that yellow line that you can see here. One right there, next one was right there, then right there, then right there. You can see what happened. I think you can see it in the video. Each and every time you had a big pullback. So if this is the beginning of a bull market, guess what? That can go up higher. We can break out. It's certainly possible, but I'm betting at least one more pullback, and that would also mesh with a drop in the market if we do, because you see a flight to safety. So either way, spread it. It's another way to diversify as well. spreading my bets by having long treasury bonds and short equities. And then after today and into next week, maybe that will change depending on what I see with Apple and Amazon. So that's the 30-year bond. The 10-year bond, same thing really. Rates peaked right here. That's early 80s. There's our downtrend line. We're right at it. We rallied into it. And it was quite a run just to get there. We're very overbought. And again, and there's price resistance as well just overhead. If the 10-year pops, if the yield goes up a little bit more, there's a big resistance level ahead. And then of course, I told you the 5-year, I've been, partial to the shorter end of the yield curve. The 5-year is starting to pop, but I think by the end of the month we'll close back down or below that level. Again, that's our long-term primary downtrend line in FVX, the 5-year U.S. Treasury bond yield. So yields down to where? Right here, maybe. That'd be a good level, and that'd be a nice drop. If you're long Treasury bond futures, be a nice trade to get that, and then maybe go long or short Treasury bonds for the yields to rise, and then ultimately a breakout of that trend line. I just don't know when. But I can say this, if this breakout sticks, and there's another reaction high there as well. That's why I don't think that slight breakout is going to go very far right now. But hey, if it does, guess what? This will crush the U.S. economy. The U.S. economy, we've had low rates for so long. It's not, back in 2008, they took them down to zero, tried to walk it back, but we've had persistently low rates for so long. The U.S. economy is completely addicted, just like a heroin addict. You guys probably know this. If a heroin addict has got a bad addiction, and you lock that person up, they can literally die from the addiction. That's why they got to go to a methadone clinic and wind down. Their body will shut down. And this economy, it can tolerate this. Rates went from zero to the Fed did the last hike was a 1/4 point. They're going to do a 50 basis point hike, and guess what? They're still historically low. But if this just continues to rise, and what's going to cause that? Inflation. If inflation runs away, and crude oil prices and natural gas and wheat and corn and soybeans and the price of a house, a car, rent, groceries, milk, if those don't abate, and that is a possibility. The Fed has, I think, I have no doubt, they've overstimulated. They've kept the rates too low for too long. They were prone to one of the worst biases in well, at least in trading, investing, and everything else, and that's confirmation bias, or I'm sorry, recency bias. Recency bias is they figured because they've been pumping low rates and keeping rates low for a long time, and we didn't see inflation after 2008, which I and some others thought we would see, and we didn't. Now it's because there was a huge deflationary counter there because it was a credit bubble. It was the biggest credit bubble in history. So that in itself, all that credit just going away when loans and debt was forgiven, I think countered it out. But now the cat's out of the bag, and see, they waited too long, and so they may not be able to tame this beast of inflation. So anyway, I know I'm rambling. So that's longer term stuff, and then just to loop back to the beginning of the video, the short term stuff is right here. QQQ, key levels. Again, don't read too much into what Apple and Amazon do after the close today, unless they just tank overnight. Because if they tank overnight and we're going to gap down, you're going to gap down below this level. I need to color this line up here on the daily chart. Again, that's the important level, about 317 or so, the recent lows. And then I look at the weekly chart, and put that line right there as well. That's it. So that would take us down to T2. A quick move to T2 and a reversal has the potential to keep those bullish divergences intact. And again, the reason I list multiple targets, each target is a level I expect a reaction. So if you're an active trader, and we hit T2 and the charts say go long at the time, there might be a trade to be made, a tradable bounce off that level. Again, I'm doing this just in advance in case this happens quick. We could just shoot down through T2. If this is, we take out that level and this turns out to be wave 3, it's going to be powerful. We could just slice through support, run all the way down to my next target or targets there, the trend lines and that 268-ish level. All right, let me wrap it up here. And again, don't read too much into today, but do know that there are quite a few divergences all the way here from the 60-minute chart of NQES right there, positive divergence. We've been moving up. This is a little trend line that we've been walking up right now in NQ off the lows. Let me zoom in a little tighter for you to see so you can replicate that right here. Take a trend line off the lows, connect all these points. Way I draw trend lines, it's the most number of candlestick shadows, that's the skinny part, or bodies. So there's two bodies, the bottom of two bodies. There's a shadow, or aka tail, another tail. So there's four reactions right there. 5, 6, 7, 8. That's what a QQQ is walking up after a divergent low. So if it breaks this trend line, and then you have the first and only support about 1309, and other than of course that reaction low. So that's what I'll be watching for after Apple reports. Oh, and a back test of the trend line as well. That's a possibility. So here's what we need to see. We, as in those of you short, you want to see this trend line break, 1309.50 right there, support break, and then any back test of the trend line fail with a solid move back below the trend line and that recent low. That's going to be a big check mark for the bears, until unless it just proves to be a little whipsaw and they reverse it. So otherwise, if you're bullish right now, you know, we've had several defenses. We're still holding above the lows. That's, use those levels in reverse. Use a stop there. You can use your second stop or an alternative stop below 1309, and then finally, you know, if the trend line breaks. Targets, I'd say back up here at least to that 13,363 level. Those were the important levels there. 14,294. And then remember, this was also a rejection off the 200-day moving averages, which are going to come in. They're going to come in a little lower if we get back up now, because we're in a bear trend right now. So the 200 days are moving down. So keep that in mind. Okay, guys, let's wrap it up here and see where we close the day. Or I'm sorry, not really so much as where we close the day, but what happens after the market today, and more importantly than that, how we close tomorrow and early next week. That should really give us an idea if these levels are going to hold and those divergences are going to play out, or if they're going to be negated. And if they are, that is to me an all-in moment. Should be a swift move down to the next targets. But stay nimble, that's all. This has been Randy Finney with Right Side of the Chart. Have a great day.